Well, hello, everyone, and welcome to the Benjamin Z. Miller Investor Networking Group. It is so nice to have investors here from around the world. I am looking forward to giving a great presentation today on net lease real estate investing. We're going to go through how that works. How can you be a landlord for Starbucks or for KFC or for Home Depot or Subway? Well, net lease is how that is done. And if that sounds good to you, having one of those as your tenants, that is what we are going to talk about today. So what exactly is net lease real estate investing? I give the example here of Walgreens in the United States, this large drug company where they sell pharmaceuticals to the public. Walgreens, they lease spaces. This is one of their buildings, but they don't own that building. It actually is owned by a commercial landlord, someone like you or me that owns that building and then leases it to Walgreens, and they sign a net lease deal. So there's some differences on a single net, a double net, and a triple net lease. We'll talk about that, but first let's go over the capitalization rate just to review. So to calculate the cap rate, you take the net operating income and you divide it by the price of the property. So let's say a property had a net operating income of 50,000 and it had a price of $1 million. Well, the cap rate in that case would be 0.05, or it's called a 5 cap. Or it could be if it had 100,000 in income, the cap rate would be 0.10, and that would be a 10 cap. So at any rate, that's how that works. And in general, the trend that's important is the lower the quality of the asset and the lower the quality of a tenant, the higher the cap rate. Whereas if it's a really good asset and a really good tenant, it's going to have a low cap rate. So let's compare credit tenant versus non-credit tenant. So what exactly is that? Well, a credit tenant is a big, powerful company, and a non-credit tenant is maybe it's an individual, or if it's a company, maybe it's a company that is just a small company that hasn't been in business very long. So a non-credit tenant is not going to have a high credit rating, whereas a credit tenant would have a high credit rating. A credit tenant is going to have financial strength. They're going to have financial strength as a credit tenant, so that is a huge advantage. A non-credit tenant, they're usually going to ask for shorter term leases, and the financing opportunities, if you're working with a credit tenant, they are much better in terms of obtaining a mortgage. If you have a tenant that's a credit tenant, it's far, far easier to obtain a mortgage. So this is something that is definitely a good situation. And then here we've got a chart that shows some of the typical cap rates where they fall. So we've got, if you're looking at, for example, a fast food restaurant, the typical cap rate there might be 5.5 to 7.
Doesn't that hit your dopamine receptor really hard? Why you got tears in your eye, Dante?
So that's something that is relevant. And then what are some examples of net lease properties? Let's take a look here at this, and we'll go through some examples. This actually shows some different examples of net lease properties. This is in the United States. So we've got, for example, Wendy's, we've got Walgreens, Wells Fargo, Taco Bell, Sonic, Starbucks. These are all credit tenants. These are all net lease type tenants that you would have. So that's how that actually works. So what's the difference between single net, double net, triple net? Well, the more ends, the less landlord responsibility. So if you have a single net lease, the tenant only pays the property taxes. So normally, if you're renting a property with a gross lease, you are paying the property taxes if you're the landlord. But if it's a net lease, you are not paying the taxes. If it's a double net, the tenant, in addition to paying the taxes, they also pay the insurance. And if it's a triple net, the tenant is paying the insurance, the taxes, and the maintenance. And then there's there's another category that's absolute triple net, or it's sometimes called a bond lease, or it's also called a hell or high water lease. This is where the tenant is responsible for everything with the building, all the expenses and the repairs relating to the building, including the roof and the structure. So that is the one that puts the most on the tenant. Now we're going to look at why would net lease be better than a bond? And I've got a chart here that shows an investment grade bond yield for years 1 through years 10. And we see that it offers a 10% rate. And now we're looking at a triple net cap rate, which ranges from 6.4 all the way up to 7.32% over this same 10-year period. So the advantage that you get with net lease that you do not get with an investment grade bond is you get depreciation on the net lease. So that's an advantage for you if you can claim depreciation to offset income. There's also the possibility with net lease of capital appreciation. When you buy a bond, that possibility doesn't exist. You're just getting the income. So those are some of the things that are advantages. But sometimes people ask me, well, why would a big rich company do this? Why don't they just buy the building if it's so great? Well, that is an excellent question. The reason these companies don't buy the buildings is in their core business, they believe that they can make more money in their core business. So Starbucks thinks that, well, we can make a higher profit margin on selling coffee instead of having our capital tied up in real estate. So that is why they lease instead of buy. Here's an example of a high quality tenant. This is McDonald's. Now, McDonald's actually owns some stores as corporate stores, but I'm showing an example here of one that actually has a landlord. So this is priced at 1.659 million. Notice the cap rate over here is 3.85%. So if you multiply the 3.85% by 1.659 million, you get 63,872 in income. So if you were to buy this building, if you put down the 1.659 million, you would receive $63,872 annually, and you would get monthly payments of $5,323, and your tenant would actually be McDonald's. Now let's take the example of a high cap rate. This is an example that I like to give because if we look at a high quality tenant has a low cap rate, 3.85%. And you remember I mentioned that the risk levels are correlated, where low cap rates are low risk. Whereas if you get a high cap rate, you have a high risk. And here we've got a 25% cap rate. Wow, that's much higher than 3.85%. So with this example property, which is a low quality tenant, it's not McDonald's, there's no strong corporate guarantor on that lease, you see a 25% cap rate. What that's telling you is that if you were to purchase this building, the income on it, the net operating income should be 200,000. So that sounds great, because you're going to put down 800,000 and you're going to get 200,000 in income. I mean, that sounds fantastic. But let me tell you the problem that I see with this deal. All that glitters sometimes is not gold. And this is an example where what happens if you buy that building and then after a few months or very quickly after you buy it, the tenant announces, hey, we're shutting the business down. We weren't selling enough fireworks. We weren't selling enough barbecue. We're shutting it down. We can't pay you. Sorry. And then you say, but hey, I've got a lease. You better pay me or I'm going to sue you. And then you find out that your lease wasn't set up properly and you didn't get a personal guarantee, or maybe you got a personal guarantee, but there's no assets backing that personal guarantee. Essentially, you could end up in a bad situation. Here's an example that shows the power of net lease. We've got a vacant building over here on the left. Let's imagine the price of it's $400,000. Imagine you're driving around town and you see this vacant building, and you call the owner and you say, hey, I want to buy your building, and because it's vacant, you can get them to agree to sell it for 400,000. You work that price out by comparing what other vacant buildings of similar square footage sold for in that town. So now imagine that after you buy it, a month or 2 or 3 later, you get a phone call, or you're at the building and somebody stops by that's in a plumbing truck and it says Joe's Plumbing. And Joe gets out and he says, hey, you know, I love this building. It's a big space. My plumbing company needs space. Will you lease it to me? And you say, well, what do you want to pay? And Joe says, well, I'll pay you $10,000 a month, because the place I was at before, we were paying 12,000. I'll pay you 10,000. And you say, okay, yeah, that works. I'll sign a lease for 15 years for 10,000. When that lease is signed, your building, because it's no longer vacant and because it has $10,000 a month in rent coming in, it's no longer worth 400,000. It's worth 800,000, and that's with a non-credit tenant. But now imagine that instead of Joe's Plumbing showing up, you hit the jackpot and Dollar General shows up, and you get a guy in a suit that shows up that says, hey, you know, I represent Dollar General, and we'd like to rent this building. We will pay you $10,000 a month. And you say, yeah, that sounds better than what the deal I had with Joe's Plumbing, because Dollar General, I think you guys are more likely to pay since you have thousands of stores and are a big, powerful company. I will do that. So you sign that same lease with them. That building, instead of being worth 800,000, is now worth 1.6 million, because the cap rate is lower on Dollar General. It's an incredible thing to take something that's worth 400,000 and now it's worth 1.6 million. Incredible. So why net lease? It's a reliable source of income. If you get a strong credit tenant like Starbucks or Dollar General, your rental income is going to come in reliably. Starbucks doesn't get divorced. It doesn't develop a drug problem. It always is going to pay you if they sign the lease. I mean, you're in a good situation, and you've got no landlord responsibilities. They want to fix everything. So what does this look like? Well, if you do a deal, there's just basically you can go through here and I'll show you an example here of a deal. This was 1.695 million.
What's called a letter of intent.
The initial process when you're buying is you put in a letter of intent. So the letter of intent, it specifies the closing date, it specifies where it's going to happen. And then once you submit that and it's accepted, you've got time to arrange your financing and to actually close the deal. So that's an example of how that looks. Now let's go through our net lease deals syndicated. Yes, you don't have to do these deals on your own. You can actually, if you have the knowledge, you can put a contract on the building, you can go arrange financing, and then you can syndicate the down payment. So let's say that in that case, you're going to raise 600,000, just as an example. Say it's a $2 million purchase. You've secured financing at 70% of the appraised value, 1.4 million. So you and some of your friends could pool the money together to get the 600,000 to buy the high quality asset. So what sort of investors are attracted to net lease? Well, the investors that are attracted to net lease, they fall into 2 categories. One are older investors. Investors that they will take a lower rate of return. They're happy with that as long as there's guaranteed steady income. So those sorts of investors find it attractive. The other category that very much likes net lease investments are big institutional investors like pension funds and insurance companies. So if you compare net lease to multifamily, for example, multifamily makes more money, but multifamily is a lot more work taking care of the asset, but net lease is hands off for the investors. So just a couple reminders. We're going to have a sign-in sheet that'll be in the window here in a little bit. Please don't forget to sign the sign-in sheet, especially if it's your first time here, and if you have any friends or colleagues that you think would benefit once you're on email list, you are welcome to invite them. So that is it for our presentation. I'm going to stop the recording and then I will open it up and take any questions if anyone has any questions.